What's the first thing expats think of at the mention of the Gulf? It might be sweltering summer heat or glittering skyscrapers. Maybe it's Dubai chocolate. But for money-minded expats looking to make a move across the Middle East, or perhaps halfway across the world, the first thought is probably zero tax.
People coming, rushing in, parking their money here, and one big reason is that Dubai is tax-free. Yes, you heard me right.
The absence of income tax has been a huge draw for expats in the Gulf who relocate from around the world. But Oman could be changing that. Oman recently announced it'll be the first Gulf country to introduce personal income tax. While some Gulf countries, like the UAE and Saudi Arabia, have other types of taxes such as value-added tax or VAT on most goods and services, Oman is making history with a levy on personal income. The tax is set at 5%, targeting annual salaries higher than 42,000 Omani riyal a year. That's about $109,000. Right now, it's expected that only 1% of the population will fall into the tax bracket. People like senior professionals, business executives, and high-income expatriates, according to experts. The tax isn't set to take effect until 2028, but it's already making waves and raising questions. One of the big ones, will other Gulf states follow in Oman's footsteps? Saudi Arabia has had repeated discussions about taxing expats only. In January, Kuwait's finance minister said her country was studying the idea. Why is Oman doing this? Basically to diversify and develop its economy. But will this also make expats rethink moving to the Gulf? We'll explore these questions in this episode of Business Extra. I'm your host, Salim Essaid. Deepthi Nair is our personal finance reporter here at The National, and she covers tax for expats and in the Gulf, and is here to speak to us about this topic. So Deepthi, welcome to Business Extra.
Thank you so much, Salim. It's my pleasure to be here.
Can you start us off by telling us what has prompted Oman to introduce income taxes, and was this unexpected?
Yes, so I think this move sets a precedent because it's the first Gulf country ever to introduce personal income tax. So the main reason for this was to diversify Oman's economy. It's very reliant on hydrocarbon revenues, and also to increase other sources of revenue. And this scheme has been in the works since 2020, and the country has been working on the personal income tax framework since 2022. So what we need to know is that this tax will only target high-income earners. So it will only target 1% of the population. So there's nothing to worry for a majority of the population.
And what do we know so far about how the income tax framework will work in Oman?
Yeah, so the tax will only come into effect in January 2028, and a tax rate of 5% will be implemented on all people residing in the country. That includes citizens as well as expats. And it will only target those people whose annual income exceeds 42,000 Omani riyals annually, which amounts to around $109,000. And for reference, the average annual salary in Oman is under 19,000 to 20,000 riyals. So a very small segment of the population will only be affected, or rather only 1% of the population will be targeted by this tax. What else do we need to know? So basically this tax policy is designed such that it will only impact senior professionals, business executives, and really high-income expats. So there will be a lot of exemptions and deductions for citizens and expats in Oman from income tax, such as there will be an initial one-time exemption from income earned outside Oman for 2 years, or such as an exemption for inherited income and gifts. So there's no need to worry for people residing in Oman, because the government will plans to introduce a 5% flat rate. And then we don't know what lies next.
How does this tax ratio compare to others? Is it enough, for example, to deter expats from wanting to come to the Gulf?
Yeah, that's a very good question. So the current proposed tax rate of 5% is relatively low compared to global rates. For instance, the personal income tax rate in the UK is set at a very high 45%. Or in the US, it is at a very steep 37%. And maybe in India, it's at 39%. So in comparison, 5% is very less, and it reduces the burden on the population. And it will also ensure that there's very little or minimal disruption to the middle class. It'll only impact the high-earning foreign workers as well as wealthy Omani citizens. In terms of whether it'll deter foreign professionals from coming to the region, I guess the other Gulf countries will take a lot of planning before it implements a similar tax rate, because they wouldn't want to lose the allure of being, of operating in a very low tax environment. So we need to wait and watch to see how it pans out.
And with that said, how significant do you see this as a development?
It is very significant because it's the first Gulf country that is implementing personal income tax. So I think it'll help strengthen Oman's reputation among international investors as well as rating agencies and other international organizations such as the IMF and the World Bank. And like its peers in the Gulf, Oman is also trying to diversify its economy away from oil. So far, it has been very reliant on oil and gas, tourism and agriculture. So this will be interesting to see how it pans out. Other GCC countries have already enacted indirect forms of taxation. For instance, VAT and corporate tax have already been implemented in the UAE. And the UAE has already collected nearly $45 billion since the initial implementation of VAT in 2018. Similarly, Saudi has also collected over $15 billion since implementation of VAT since 2018. Oman is the last one in the Gulf to implement VAT so far. But I think any direct enactment of tax could be like a double-edged sword for Gulf nations, because the allure of 0% personal income tax is the number one factor attracting professionals to come live and work in the region. So I think other Gulf countries will take it slow, but this is a very important development in the Gulf.
Yeah, it seems like they're finding ways to bring income to to bring in revenue to diversify their economies, while at the same time being a place that, people would want to come to with those incentives such as, no personal income tax. So, yeah, let's see how that pans out. And Deepthi, thanks for speaking to us.
Thank you.
We'll be right back after this.
Are you looking for deeper insights into the biggest news stories shaping the Middle East?
The U.S. will take over the Gaza Strip.
Listen to Beyond the Headlines, a weekly current affairs podcast from the national news in Abu Dhabi.
Surrender is not an option.
We break down the news and bring you in-depth analysis and expert perspectives on everything from regional power shifts to ongoing conflicts, giving you the full picture behind the events shaping the Arab region. Listen to Beyond the Headlines every Friday on Apple Podcasts, Spotify, or wherever you get your podcasts.
This is Business Extra, and today we're talking income tax in the GCC. I'm hearing now from Daly, a partner at the Gulf Tax Accounting Group in the UAE. David, thanks so much for speaking to us.
Lovely to see you again. It's been a while, and pleasure to speak with you as always.
For decades, the GCC was known for its zero taxes policy. What economic reasons shaped that financial or fiscal model?
Well, fundamentally, it was because it was seen as a hardship location. And we've had various ones across the world, but this is probably the most famous purely because of the commodities that are produced, oil and gas primarily. And that was part of the bargain. You came out to this part of the world and you got looked after. If you look at where I am now in Dubai, you go back to the 70s, it's a completely different place. If you were to land there now, at that time, you'd be shocked by the difference between where it's gone to, where it's come from, and where it's ended up. And that required convincing people to come here and make a go of the place, which they've done. So now that that is done, we move on to a new stage. We're growing up. But just on the tax thing, this isn't the first time we've seen an attempt to bring in income tax. It might have been 2004, and forgive me if I got the year slightly wrong, but the Saudis did at one point talk about bringing in income tax. There was a pushback locally, and that was the end of that. So it's Oman who's broken through. I think they've picked their timing well. We now have VAT since 2018. We got corporation tax, which is popping up. So this is part of that same journey.
Yeah, exactly. I think from 2004, around that time till now, the region has developed immensely since then. And if anything, it's not a hardship environment, it's a luxury environment for many. So yeah, that really speaks to that development of why now. And we've seen in recent years that the introduction of VAT and corporate taxes in some Gulf countries and here in the UAE. Can you say what drove that change in the time span that you had said?
Well, there was always a lot of pressure internationally from supranational bodies for the UAE to be, or not the UAE, the GCC to become more mainstream, and that involved bringing in VAT, just from a government funding perspective, corporation tax and eventually income tax, which will appear everywhere. What's different between VAT and corporation tax is how it is happening. So in 2017, we had a GCC framework for VAT. And this is something I think we're beginning to forget at a time when corporation tax is appearing and now we have income tax. We forget how VAT appeared and how it works legally. All 6 countries committed to bringing in VAT within a short time frame, which hasn't happened. And once that happens, that law comes into force. And what it means is all 6 countries must have at the same time the same rate of VAT. So imagine next year the Kuwaitis bring in VAT and close the loop. Well, the highest rate of VAT in the region's 15% in Saudi. Does that mean everybody must go to where Saudi is? Or are Saudi and Bahrain forced to come back to where the UAE is at 5? And we don't know because that treaty didn't include a system for arbitration between the countries. Now, the bigger question from that is if we did it for VAT, why haven't we done it for corporation tax? And should we be looking at something from a GCC perspective that we do something similar for income tax?
Yeah, and with that, when you're looking at the broader goals of the region in the Gulf, how does the recent introduction of income tax in Oman fall into that vision?
Well, it's diversifying income and creating certainty of income. Look, it's not going to raise huge sums of money. First of all, let's stay in dirham, the first 400,000 of dirham is tax-free. So you have to earn more than that. And then there are costs which are allowable against that. So if, for example, you're educating your children and paying for it yourself, you can deduct that against the taxable income element. And there's other things as well. So I think this is more about the principle that it now exists. Look at the history of income tax. The first time it appears globally is in Britain during the Napoleonic Wars to pay for it. Did it go away? No. Taxes never go away. You basically you create a beachhead, and from there it grows into something. So what you want to do from the beginning, if you are going to be the person who breaks ground on it, is to try and make it as simple as possible so everybody can come on board at inception. And then they can grow with that and they can feed back into it. And it allows for a better acceptance that this is part of how the economy currently works and how it's going to work going forward. It's not a thing to be scared of. It's normal.
Yeah, that's well said. I think it's a mindset change. So that takes time and needs to be done gradually. And then whether, as you said, this is bringing in high government revenue or not, that's something for the future. But this is the initial step and maybe it's a gradual process. And can you explain why the UAE or Saudi has avoided income taxes thus far?
Saudi has, because when they tried it, there was pushback. Again, understandable. I think Saudi may try again, but that would probably be in a post-corporation tax launch environment, or what I suspect is at some point they'll probably bring in corporation tax and income tax together. I actually thought that that's what would happen in the UAE. Corporation tax arrived here earlier than I thought it would. I honestly expected that they'd bring them in at the same time, at the same rate. And part of the reason you would do that is to stop individuals and companies trying to game the system to offset taxable revenues in one place and put them somewhere else. So that's not going to happen now. There was a lot of international pressure just to get it done, to get a standard 15% corporation tax on all entities earning or having revenues of $750 million euros, I believe the limit is. So what we have here in the UAE is 9% on entities below that.
So if we're going that direction with these new taxes, on the corporate level and others being implemented, and then now with Oman making this decision for 2028 with personal income tax, the big question is it likely or feasible that other Gulf countries will follow suit?
Oh, it's inevitable. It's win. So let's have a look at where it's likely to happen. Kuwait seems to be the outlier because it hasn't even done VAT yet. So that's going to be the last place most likely. Where is the next place going to be? Unsure. If you were willing to put a marker down, you might suggest here. But I would have said only after corporation tax is bedded down. Let's look at the time. 2018 VAT. 2023, 5 years later, we get corporation tax. So you might suggest 2028, 2030, we could be looking at personal tax as a logical progression of a normalization of the country from an international taxation environment system. And then you can apply the same thinking to the other countries. The next one in line would probably be Bahrain. Qatar would be one of the outliers.
Mm. And on the flip side, from the looking at governments to looking at the people that actually move here, what does this mean for expats living in the region? And also, what will the new tax laws mean for people abroad that are planning to move to the region? And usually the incentive has been no personal income tax.
Well, it's interesting. One of the carve-outs in the Omani legislation is, say you move to Oman on the 1st of January 2028, which is when the income tax takes effect from. Any residual income that you earn after that date for 18 months from the tax jurisdiction you were tax resident in doesn't come under the Omani envelope. The idea is that you get a transition relief. So, which is very, very sensible. And I would imagine other people would copy it at different lengths. I think the big risk they all face in the region is to ensure whatever system they do bring in doesn't get very complicated. I've got my notes in front of me in terms of what exemptions are. So, for example, one of the carve-outs in Oman is for intellectual property rights, the exploitation of those. And it allows for 5 years income from the date of registration. What's not clear to me, and I may have just missed it, is does that only apply where that IP was created in Oman? Now, that's a good incentive because you want the economic activity to happen in your country. So you write the code accordingly. Profits made on investments in the Omani Stock Exchange sit outside tax as well for individuals. So they've done some very, very sensible things. However, the more of this you do, the more exceptions you create, the more complicated the return. One of the things I thought was interesting is you only have 6 months from the end of the financial year, which is going to be January, December, to file. With corporation tax, it's 9. Now, you can argue that that's a much more complicated ask than personal taxes. I would say in a new system, you know what? Why not make it 9? You can always bring it back to 6 once everybody's settled down with it. But look, these are early days. The Omani government may change its mind. It's got a couple of years to do it. And again, that is one of the wonderful things I think they've done is we are in mid-25. This goes live in 28. There is time for feedback to the relevant authorities in Oman, and there's time for the relevant authorities in Oman to adjust. What we have right now is primary legislation, what we would call here, say, a cabinet decision, or maybe even a ministry decision. They've indicated that we're going to get an executive regulation, the type of law you typically see coming out of, for us, the Federal Tax Authority. And in there, that's where the detail is going to be. So they have given themselves the flexibility and, more importantly, the time to amend the system before it goes live. And these are wonderful things. And I would say regionally to any other government watching this is definitely the way to do it.
Exactly. We're speaking about, about 3 years from now. And it seems like, as you said, changes will happen during that period. They're testing things out. And this is definitely the trial for the region with Oman leading this. And what that will look like, it seems like they're developing policies to make sure that expats don't feel the hit too hard. But at the same time, they are changing the system and slowly getting that revenue. So, I guess we'll find out what that will look like over the coming years. But really good insights. And thanks so much for that detail. I think we have a lot to look forward to. Thanks, David.
Okay, you're very welcome.
That's all for this episode of Business Extra from The National. Make sure to check out The National's podcasts wherever you stream. Also, we want to hear from you. Help us improve our podcast by taking our 2-minute listener survey. You can find the link in this episode's show notes. This episode was produced by Yasmin Al-Taji. Arthur Edison is our audio engineer. Our podcast editor is Duat Farid. And I've been your host, Salim.